My name is Steve Aronsoff. I am the Senior Vice President of Marketing at FlexPay. And today we're going to talk about the single largest causes of subscription customer churn and how companies can deal with it. Before we get started, just a few housekeeping items. Throughout this presentation, we're going to be supporting questions from an audience. Just use the Q&A box and we will reply to you individually with answers. So let's get started. There are known root causes of customer churn. Businesses in subscription and recurring billing models know that customer retention and customer lifetime value are critical metrics to optimize, because the longer a customer is active with the business, the more revenue is earned, the higher the profitability. And subscription businesses invest enormous resources to try to avoid churn and extend the customer lifespan by trying to provide better customer satisfaction and great experiences. The most common drivers of customer churn are well understood, right? We have customer fatigue, where the customer no longer sees value in the product or no longer has a need for it. Perhaps a customer is lost because they found another provider that is cheaper, offers a similar product. Perhaps the customer goes through a negative experience which causes them to want to cancel with the company. But the reality is there's actually a fourth cause of churn, which is the single largest cause of churn in subscription businesses, driving up to 48% of all customer churn. Unfortunately, this last cause is not usually understood or managed by businesses. And the result of that is businesses often fail to address the cause of almost half the churn they face with their customers. So how do we close the churn gap? A research study by FlexPay has found that this 48% of customer churn is caused directly by declined credit card payments. Let me restate that. This means that almost half of all customer churn is not caused by customers proactively ending their relationship, but by declined payment issues. And the relationship between payment issues and payment authorization errors and churn may not be well understood or obvious, but we're going to spend some time talking about that today and really dive into what these root causes are. We'll dive into both the known and the hidden business pain that declines cause. We're going to talk about why some decline recovery methods and tactics actually are themselves a creator of customer churn. And we'll also dive into probably the most important, which is the best practices of decline payment recovery that will optimize both revenue and satisfaction and customer experience. So let's talk about the root causes of why payment issues exist. The reality is that the payment system is facing a tremendous amount of change. There is an explosion of e-commerce devices from mobile devices. The gig economy, Airbnb and Uber are generating millions and millions and millions of transactions that didn't exist 5 or 10 years ago. The pandemic greatly accelerated the shift from physical to e-commerce purchases. Customers have really adopted recurring billing and subscription services because of the convenience they provided them. And of course, we all are aware of the large-scale data breaches and bad actors and cyber criminals that are increasing their efforts and their sophistication for fraudulent transactions and the pain it causes for banks. Now, the reality is that when we look at failed payments, what's not well known is that when payments are declined by the credit card authorization systems, the reality is that 2/3 of all failed payments are caused not by fraudulent card usage, but by false declines. A false decline occurs when the bank is making an authorization decision on a payment request. The merchant is a legitimate merchant looking to sell a product. The customer wants to buy the product, and the card authorization system identifies some risk factors rather than identification of true fraud, and they decline the transaction. This is a false decline. Now, the false decline rates are concentrated with different types of transaction types, particularly what we call CNP or card not present. Of course, there are other reasons for card declines beyond false declines like non-sufficient funds, but the majority of these are the false declines. And of course, the pain that this causes for both merchants and customers who legitimately want to transact is enormous. When we look at where false declines occur and payment declines occur, there's very different trends based on where the transaction occurs. We talked about card not present. So if you walk into a store and pay with a credit card, you're going to use the chip. It's a secure transaction, and the payment authorization systems recognize this. And the average decline rate is only 1%, so that the system is working as intended. But when you move online to e-commerce, the decline rate jumps up to 15%. And for businesses with recurring business models like subscription services, the decline rate jumps up to 24%. That's 1 in 4 transactions that are legitimate that are not being approved by the credit card systems. Now, why does this occur? This is being driven by the increasing costs that banks are having to bear from actual fraud. Last year, over $30 billion was borne by costs on their expenses for the payments they authorized that turned out to be legitimate that they bore the liability for. So in response to this, banks are increasingly shifting the liability, the risk of these fraud to merchants. And it's not intuitive why this occurs, but what they've done is in order to try to avoid approving fraudulent transactions, they have increasingly made their algorithms more conservative and are actively looking for risk factors versus fraudulent transactions. And so this results in those transactions that are legitimate being declined. And the cost of this is enormous, over $400 billion in revenues lost globally every year for merchants based on false declines. And again, this is where both customers and merchants are paying the price of this problem. Even worse, this is from MasterCard's own data, that the customer experience is very poor for customers. When a consumer experiences a false decline, not only do they, if they don't stop buying from the merchant directly, they will reduce their purchase for them. So the consumer, when they experience the false decline, when they're exposed to it, it creates a negative customer experience and it directly impacts revenue. So it's, again, bad for the customer, bad for the merchant. And the reality is that within the payments ecosystem, we have a misalignment of objectives that really is the root cause of why this occurs. We have merchants and customers that want to transact with legitimate transactions. Again, we're not talking about fraud. We're talking about merchants selling legitimate products and customers wanting to buy from them. But the banks and the authorization systems are looking to minimize their fraud. And this is where this misalignment of objectives occurs and where the false decline problem is coming from. So the good news is there is a new solution category of technology called Payment Authorization Management. Payment Authorization Management, or PAM, is the application of technology, expertise, data, and processes to improve the overall payment authorization decision accuracy and increase legitimate transactions between merchants and customers. So what PAM, or Payment Authorization Management, actually helps is it helps the merchants complete more legitimate transactions, which of course helps increase their growth and profitability. It improves the customer experience by reducing the payment blockers that are preventing customers from buying the products and services they desire. And it also helps reduce the bank's fraud losses by increasing payment decision accuracy. Now, I'm going to go through some principles with Payment Authorization Management best practices, and these are really important because when we talk about PAM, how PAM and the strategies that are developed around PAM are very important. The first principle for Payment Authorization Management is that we want to avoid the failed payment from occurring in the first place. There are best practices companies can use to avoid failed payments that are easy. What we really want to do is avoid the chance that a risk score assessed on a transaction crosses the failure threshold. So the time of day when payments are submitted for approval submission, for example, if all requests are batched up at 12 o'clock at night because this is when system usage is low, that is a trigger for the bank. So managing the time of day, making sure that the merchant category code is accurate, aligning the location of the merchant bank to the regions where your customers are located, ensuring that all data fields are accurate, and that the transaction type codes are accurate. These are easy steps that merchants can take that will often have a positive impact on overall approval rates. But of course, failed payments do occur, and when they do occur, what we really want to do is optimize the payment recovery rate, the overall percentage of recovered customers, because we cannot be overstated that an unrecovered failed payment is not just a lost payment, it results in a lost customer. And when a customer is lost unnaturally early in a subscription relationship, it actually eliminates the revenue that's earned from future billing cycles. So the LTV of that customer is dramatically reduced, which causes, again, enormous pain for subscription businesses that estimate out their spend for what they can afford to pay for new customers. And if that is not realized, then they are unprofitable. The next principle is that we want to avoid customer visibility to the failed payment. Customer visibility to the failed payment can occur because service is interrupted, if the merchant cuts off the service or product delivery as a result of failed payment, or if a dunning or customer service recovery approach is being used. Again, we've seen that when the customer has visibility to the failed payment, they often choose to end the relationship or reduce their purchase levels with the merchant. So again, when customer visibility is created, this also is a driver of customer churn, and we want to avoid this. Now, there are times when recovery is unsuccessful, when we actually cannot reduce the visibility. So there are times where it's appropriate to use more interactive methods, but we want to reserve those when invisible recovery is not possible, because again, our principle of trying to maximize the recovery percentage rate can be improved by using additional tactics when invisible recovery fails. So summarization of best practices, again, we want to ensure that the solutions that are employed for payment recovery are invisible to the end customer. There's another principle around the usage of AI machine learning, and AI machine learning is a great tool to use for failed payment recovery because there are hundreds of reasons why a payment would fail. And we want to have technology that is capable of creating individualized payment resubmission strategies to optimize for recovery. Next, the algorithms trained that you use for AI have to be working with very large training sets, literally in the billions of records, so that they have exposure enough failed payment and successful payment transactions to make good decisions. These algorithms have to be embedded with payment knowledge of this ecosystem itself. And it's not enough to just have a training sample. The algorithms have to embed the knowledge of how the payment system works so it can be applied to apply the best cost strategies. And lastly, the payment authorization system is knowledge that exists within the overall payments tech stack that companies have. The integration of the system with payment gateways and CRM billing systems is very important. And so having access to these networks is vital to ensure that a PAM solution can plug in naturally. So when we talk about the payments tech stack, again, the CRM, the billing system that are used to identify which customers bill when and how much, and the billing system itself that submits the payment record into the payments processor. We talk about payment solution, the PAM solution really being the missing link there. In most companies, that the third leg within the payments tech stack is the PAM solution to ensure that the recovery on failed payments is as high as possible. I think the analogy I like to use is you would never choose a billing system that only successfully billed 85% of your payment requests. And so the PAM solution is able to recover the maximum amount of failed payments in the same way. So let me introduce the FlexPay solution. FlexPay, the invisible recovery solution for failed payment recovery, is an AI-powered solution that is powered by unique capabilities. We have algorithms informed by decades of payments industry experience. Our failed payment recovery system has models trained on over 5 billion payment transaction records. And the invisible recovery solution is powered by AI that creates individualized payment resubmission strategies that optimize for authorization approval. So there are obviously a number of solutions within the PAM space. The FlexPay invisible recovery system, we believe, has the highest recovery rate, which does align against the PAM best practice of optimizing for recovery to optimize the revenue and the customers they're able to save. So how does the system work? When a card is submitted, it hits into your billing system, it hits the payment gateway, which is where the authorization decision is made. It's important to recognize that the FlexPay system plugs directly into the existing infrastructure you have. If the system is successful, or the payment is successful, the acquirer will approve the payment. In the case where the issuing bank denies the request, though, this is when the invisible recovery system will be invoked. Our API is hit, and our system will deliver a resubmission strategy that optimizes for payment success or resubmission success. Again, we piggyback on the existing gateway and the existing tech stack to make it very easy to plug the system in and to recover the maximum amount of failed payments. So to summarize the total FlexPay value and the value of our payment authorization system solution, we deliver the most dollars recovered. We average 80% improvement in declined payment recovery over what companies are using today. Now, it's not just important to recover the maximum amount, but actually do this quickly. We have faster cash flow delivery. In fact, our system delivers an average recovery of just 2.9 days, what companies typically take 30 days to recover on their own. So faster cash flow recovery. It's a risk-free model, meaning that our performance is based, our pricing is based on our performance. So we only charge when we actually collect for you. We have a system that is invisible to the customer, meaning that our customer experience is enhanced. We avoid service interruptions and customer dunning interruptions. We eliminate the churn that's directly caused by product service delivery interruptions. Again, eliminating the 44% of customers who stop buying because of exposure to the false decline. And probably most importantly, we talked about the fact that when a customer is lost, the future stream of revenue is also lost that they would have delivered. On average, our FlexPay customers see almost 3 months of successful billing cycles after recovery, which proves that the additional revenue we were able to cover goes far beyond the monthly recovery itself. And this has a direct improvement on overall company growth. The acceleration of recovery means that the additional recovery the company would see is quite a bit higher. This is demonstrated in this chart where we're able to show that the growth is cumulatively created. We have compounded benefits based on not only the current month of recovery that improves on in-house solutions, but also is able to deliver in future months, which causes a growing acceleration of revenue improvements for businesses. This actually has the impact of accelerating overall company growth, which is a huge impact. In fact, there really is no other solution that a company can deploy that has the same kind of impact on overall growth. In fact, FlexPay clients see an average increase over the first 12 months post-deployment of 33% in total revenue collected, which is enormous improvement in overall business performance. So to summarize, FlexPay closes the gap between the billions of dollars lost to payment declines and the full revenue potential that we can recover for you. Thank you very much, and we appreciate your time today.